Hey everyone, welcome back to Corporate Decoder. Today we're diving into Envela Corporation's latest filing. It's like they're playing financial hide and seek, except we're here to find all the clues. Get ready because this report has a surprise twist involving stock buybacks, making you wonder if they think their stock is a bargain. Alright, this isn't a full financial report, it's a quick update, like a corporate status update. The main thing here is about Envela deciding to buy back more of its own stock. So the people in charge, the board of directors said, let's buy some more of our company's stock. They're adding another 100,000 shares to their existing plan. That brings the total amount of shares they could potentially repurchase to 1,100,000. How will they do this? Well, they can buy shares on the open market, meaning like anyone else buying stock. They could also use something called 10b5-1 plans, which are pre-arranged trading plans that help companies avoid accusations of insider trading. Or they might do private deals or other methods. The exact way they buy back stock will be decided by the CEO, the Chief Executive Officer, or the CFO, the Chief Financial Officer. They're calling these people the authorized officers. The price they pay and the conditions of the purchase will be up to the CEO and CFO, but they have to follow all the rules, like federal and state securities laws, SEC regulations, and Nevada law. Because Envela is incorporated in Nevada, this whole plan is good until March of the next year, meaning they have about a year to buy these shares. Now, here's a key point. What happens to those shares they buy back? The company might get rid of them. When a company retires shares, it's like those shares never existed. It reduces the company's capital accounts, which can change how the company looks on paper. This decision to retire the shares is also up to the CEO and CFO. So what does all this mean? Well, a stock buyback can be a signal. It can suggest that the company thinks its stock is undervalued, meaning they think the price is lower than what the company is really worth. By buying back shares, they reduce the number of shares available in the market, which can increase the price per share. It's also a way of returning value to shareholders. Instead of paying a dividend, they're trying to boost the stock price. Now, the decision to retire those shares is interesting. It's a bit like the company is shrinking its size, at least on paper. It reduces the amount of equity on the balance sheet, which can change some financial ratios. Envela is a company that focuses on resale and recycling. They operate through two main business segments, DGSE, which focuses on buying and selling jewelry, diamonds, and precious metals, and IT-Aid, which is all about recycling electronics. So they're in the business of giving old items new life, which is a business that can vary wildly. From a high level, the decision to authorize a stock buyback program can be seen as the company thinking that the shares aren't priced correctly by the market and they are worth more than their current market valuation. This will likely be seen as positive sentiment towards the stock by the markets, depending on how the market views the overall company in general. Looking at the numbers, Envela seems to be cautiously optimistic. They're making moves to potentially increase shareholder value, but they're doing it within a well-defined set of rules. It's a calculated risk and it will be interesting to see how it plays out over the next year. The company must feel confident in their ability to generate revenues, at least enough so to have excess cash available. Thanks for watching. If you found this breakdown helpful, give us a like and subscribe for more corporate deep dives. Let us know in the comments what company you want us to decode next.